Hello everyone, welcome to the new session on investments. Today we would be discussing about few critical numbers which everyone should be knowing before they start investing or start doing the financial planning. These are some basic thumb rules you need for financial plannings. So as I said before, this video is just for informative and educational purpose. So let's start. So first thumb rule for any financial is speed of growth. Before making any investment, you should know at what rate this investment is going to grow, how much time will it take to get the expected returns. So first rule is rule of 72. So rule of 72 says that you have, in any investment, if you divide the number 72 with the rate of return, then you will get the number of years which is required to double your amount. So for example, you are investing 10,000 rupees at a rate of interest of 8% annually. So in 72 divided by 8 is 9. So it will take 9 years for you to double your investment from 10,000 to 20,000. So if you need reduce the number of time, then you will have to increase the rate of interest. So next rule is rule of 114. So if you want to calculate number of years it takes to triple your investment, then divide 114 by the rate of interest. If you divide 114 by the rate of interest, you will get around the number of years which is required to triple your rate of interest. So here it would be around 13 point something years. Next is rule of 144. So you have to divide 144 by the rate of interest to find number of years it would take to quadruple your investment, which is the double of rule of 72. So next thumb rule is you should also not just calculate the time and the speed at which your investment is growing. You should also be knowing about the speed at which your investment is eroding of its purchasing power. So as most of you would have learned or at least heard about the word inflation. Inflation is the rate at which the price of goods is increasing. So as the inflation increases, your purchasing power of your investment or your money decreases. So you need that to calculate the erosion rate. So what's rule of erosion rate tells? It tells that the time or number of years which require for your investment to lose its half of its value is you have to divide 70 by the current inflation rate. So for example, currently you have a 10,000 rupees and you can purchase a set of things with 10,000 rupees. As inflation grows, the cost of those things will also increase. So consider current inflation is 5%. So if you divide 70 by 5, which comes around 24. So it takes around 24 years. So after 24 years, currently whatever you have your value for 10,000 was, it will be reduced to 5,000. So today whatever you get at rupees 5,000, you will have to pay 10,000 after 24 years. So this seems a very long time frame when you consider that for such a small amount, but if you calculate the inflation rate for your education, which comes up in lakhs of rupees, so this would be an interesting figure. And currently the inflation is not under control, so this is a good news for our country. But you should always monitor the inflation rate, and you should always consider that before investing. So if you are investing something for 20 to 24 years in a long-term perspective, you should also consider that your purchasing power has also reduced to half during that period if we are staying at this inflation rate. Next. So next basic thumb rule for any investment is that you always has to set aside a fixed amount from your earning for savings, which we call pay yourself first rule. So basic rule is that if you are a new to the world of employment or world of earnings, a new youngster who has just completed his college and joined a job or started a business and doesn't have much of responsibilities, then its basic thumb rule is that you have to save at least 30% of your income. 10% should be for savings, which is fixed savings. 10% should be invested, and 10% should be for giving, for charities. This is the basic thumb rule which most of the great financial planners recommend. But depending upon your capacity and your responsibilities that you have to handle, this number can vary. But anyhow, you have to keep at least some amount each month from whatever you earn as your savings. So next thumb rule is what we call rule of allotment. So rule of allotment says that you always should allot so suppose you are 25 years old currently. So whenever you create investing portfolio, there is some percentage which you are allotting to equity and some percentage to debt. Debt is fixed return income groups, which is less risky, and equity is variable return investment groups, which has higher risk. Okay, and this is less risky. So normally you divide your investment portfolio into basic these two blocks. So rule of allotment says that your equity holding should be 100 minus your age. So if you are 25-year-olds, it should be 75%. So 75% of your investment should be in equity and 25% in debt. So as your age increases, for a 40-year-old person, 60% should be in equity and 40% should be. So when by the time you reach your retirement, you should move your only 40% should be there in equity and move the 60% to your low risk of debt investments. So this is what this is also one of the basic thumb rule for investment. So all the youngsters who are new to investment, you try to allocate maximum at least 70 to 75% of your portfolio in equity, which gives you a higher return over a longer period of time. So you have time on your hand, you have less responsibility. This is the best time to invest. Then the rule of average returns. Rule of average returns is the basic minimum average returns you can expect on various forms. So if you are investing in equity, you can invest an average return over a period of time of around 10 to 15%. So if you are good investor, if you are good educated, making wise decisions, then you can earn more than 15%. There are persons who are consistently earning 20 to 30% returns in equity. And if you are very bad with it and you don't know what you are doing, then your return can also go in negative also and below 10%. So basically those who are earning consistently more than 50% are considered as winners in equity market, and those who are not able to earn more than 10%, they are considered losers in equity market. And on an average you should be earning 10 to 15. Similarly, if you are investing in bonds are basically a fixed returns debt instrument. So bonds should on average give you a returns of around 5 to 8% per annum. And if you are holding cash or putting your cash in savings account or keeping it in just in banks, a maximum return that you can expect is 3 to 4%, and currently, as I told, inflation is over 5%. So net return turns out to be minus 1%. So it's not at all ideal to keep your maximum amount of your balance or savings in cash form or in just savings account. So next rule is rule of net worth. So rule of net worth is an relative terminology. So basic rules state that if your net worth is greater than, your age multiplied by your after tax income. Consider if it's your 25 years and your after tax income is around 5 lakh rupees, which comes around 1 crore 25 lakhs. So if your net worth is more than this, then you are considered as a rich individual. So this is an variable term and varies from places to place. So if this, and if you need to be an good wealthy, if you need to be considered as good wealthy, then your net worth at the age of 25 should be around divided by 20, which is an relative divisor term, which comes around 6 lakh rupees. If you are earning or you have a net worth of 6 lakh at the age of 25, then you are wealthy, means good. But if you have around 1.25 crores, then you are rich. So these are the basic thumb rules that anyone should be knowing, or basic numbers, basic calculation that you do before contacting any financial advisor or consulting with any qualified personnel for financial planning. So I would recommend that youngsters go through your personal net worth and investment rules and check these thumb rules. Please comment if you have any suggestion or any doubts, and subscribe to my channel to stay connected. Thank you.